So thank you so much, everyone. Good day and welcome. My name is Thandiwe Dlamini, and I am the program manager for the AUHF. I am based in Joburg, South Africa, and I am with my colleagues, Kesia Rust. You've heard her looking at everyone and seeing who's joined. She is the Executive Director of the Center for Affordable Housing Finance, and also Nasipi Dumile, who runs the communications for both CAF and the AUHF. So as Casey has already asked, please kindly introduce yourself in the chat. And I will also ask Casey perhaps if you can share the poll, because now I'm presenting a slide, I can't go onto Zoom. So it will be the first one. So if you can please tell us where you are from, and the poll will help us, will also help our chair for today's session, Mr. Bezant, who introduced himself later after I've just given a background of the AUHF Academy. So on behalf of the AUHF and CAF, I'd like to thank you all for joining us for today's AUHF Academy webinar session. So this webinar sessions will be a year-long activity for executive education and capacity building initiative, which is designed specifically for professionals working across the affordable housing sector. The idea behind the academy is simple. Africa's housing challenges are complex, they are evolving, and they are interconnected. And we need stronger knowledge exchange, practical learning, case studies, and collaboration across the sector if at all we are to respond effectively to the problem across our different roles in the value chain. So the Academy brings together policymakers. It brings together policymakers, financial institutions, developers, researchers, investors, housing practitioners, and also different stakeholders from the public sector across the continent and also from across the globe for global experience as well. So what should we expect from the AUHF Academy? So from the AUHF Academy, we'll have monthly webinars similar to what we are having today. We'll have different series and different topics. We'll also have quarterly reading and discussion groups, some executive courses, and peer exchange labs, and possibly study tours from across the region and across the globe. And we'll also have a graduation right at the end during our AUHF conference, which is coming up in November this year. How does the AUHF Academy work? So we ask each and every participant to please, if you haven't done so, please join the AUHF Academy, and by completing a very simple online registration form that we have. We will also share the link in the chat, and we are going to have like an annual calendar that will guide you on all the sessions that will be running, and sessions will be running from one AUHF conference to the next. And there is a benefit if you actually go and register as an AUHF Academy member, because you will have access to curated readings, learning materials, and as the AUHF Academy evolves over time, we will have members-only learning engagements. So you would want to register for the AUHF Academy. And also we will have a participation recognition certificate. This will be after you have completed at least 10 learning events. That is, we have had our launch, which we did in April, and today's session will also count. So if you've attended those two, you already have 2 sessions and events that you have attended. So as we roll them out, please make sure that you attend at least 10. And at the AUHF conference, which is coming up in November, we'll have a graduation, and we'll also recognize your efforts formally through the certificate for the AUHF Academy. And importantly, the Academy is designed to be practical, and it is practitioner-led. So you are leading this conversation. So we want these sessions to move beyond just theory and focus on real experiences, real exchanges, and scalable solutions relevant to Africa's housing market. What are the upcoming learning sessions that we have? So today's webinar series on housing microfinance is a 3-part webinar. today's session. We'll have another one next month and another one coming up in July. Please do register for those as well and make sure that we come. We have the gurus to take us through the series, and we look forward to the case studies that they're going to share with us during the course of the webinar series. We also have a rethinking sites and services webinar series that we want to also engage in. This will basically be it will be from lessons from research that the World Bank has commissioned, practical experiences from AUHF members like a development workshop in Namibia and Abermont, which will also come and bring and share their experiences during that session. We also have another session on South-South exchange. So this is a session that will be led by the Asia Pacific Union for Housing Finance through their secretariat, the National Housing Bank of India. So we will learn from their experiences and how African stakeholders can actually reflect on some of the lessons and see how they can strengthen their housing finance systems. And another session that will be coming up, which will be led by David Gardner and CAF, will be around housing and the economy. CAF has delivered the HDFC. I'm sure most of us have seen the framework. So we are going to come back and introduce the participants to the framework and practical tools for applying the methodology going forward. So please do sign up for the AUHF Academy. Please do come back to us with any feedback. Tell us the type of topics that you would want us to look at during the whole program as it develops and evolves. And please do share feedback on how we can improve and how we can make it better. Don't hesitate to reach out to me. I will also share my email again on the chat. And now for today's session, I'd like to hand over to our chair of the day, Chongo Bezant, who introduced himself and his colleague as well and take us through the day. Thank you. Over to you, Bezant.
Thank you, Tandiwe. So I'm really honored to have this opportunity to lead this first webinar under the AUHF Academy with my colleague Stephen. Just by way of context, I have been working in the field of development finance, financial inclusion for the last 2 decades, predominantly in the context of providing consulting and technical assistance. I currently work with a Swiss-based global impact fund, Symbiotics. We provide debt financing to banks, microfinance institutions, working in the social impact space aligned with SDGs. A core focus of ours includes also providing capital debt financing to intermediaries who provide housing microfinance or are looking to unlock access to capital for affordable housing. This is very much in the broader context of improving livelihoods for low-income households, where not only access to capital for their livelihoods and businesses is important, but for dwelling. Hence, affordable housing microfinance becomes part of that dimension where that we are actively involved in. Recognizing that unlocking access to capital sometimes goes beyond the capital, but also expertise comes in the role of technical assistance, which I've been actively involved in. And at Symbiotics, I lead up Symbiotics Capacity Building, which is a technical assistance business line of the group, where we provide support, including expertise on affordable housing. It's from that context that I'll be sharing the experience that I have, that we've had, in terms of how it is that we make affordable housing and housing microfinance work in the African context. And in many of the initiatives that we've been involved in, I've had the opportunity of collaborating with an old friend and colleague, Stephen, whom I'll let introduce himself.
Thank you. Thank you, Bezant. Myself, I'm Stephen Wanjala. Been involved in the development finance space for the last over 30 years, working across Africa, and I would gladly say I'm among the first pioneers of housing microfinance on the continent, that I've been promoting housing microfinance for the last 20 years I've had an opportunity in working around 26 African countries promoting housing microfinance, working with cooperatives, microfinance institutions, development partners in promoting these agendas. So we'll be sharing with my 20 years experience of having done this across the continent, of what is emerging and how we need other partners to come on board to fix this nascent sector that is a high demand on the continent. Thank you.
Thanks, Stephen. So in the context of the priority that affordable housing and housing microfinance has been provided by AUHF and different development institutions, stakeholders, we are trying to solve for the challenge that according to significant research, there's a significant gap in terms of housing in Africa. In fact, it's been quantified that the need for housing in Africa come 2050 will be up to as high as 1.5 billion new homes or households that require housing. This is a significant gap that cannot be left to individuals to solve. It cannot be left to the public sector. It cannot be left to the financial sector. Housing, unlike many other key essential services, cuts across different sub-themes of the economy. And this is why through housing microfinance, we really try to understand how these different initiatives, how different service providers, ecosystem players can be brought together to contribute towards closing the housing gap of 1.5 billion that is estimated as a need by 2050. Worth also noting in Africa is that the bulk of the housing is built through what is called incremental housing over time. 60% of the housing is built through incremental housing. We will be elaborating a bit on what it is that we refer to incremental housing and how housing microfinance then becomes an important ingredient for unlocking this capacity of incremental housing that is ideally fitted for the African context. Also worth noting, comparing incremental housing to mortgage financing, which is what people initially think of when you think of housing financing for housing. You think of mortgages, depending on which country you're in, what is called bonds. Only 5% of would-be households can actually afford having access to a mortgage or a bond. So this leaves 95% who need to have different mechanisms on which they'll need to have access to capital for housing services. And this is where, again, incremental housing becomes an important enabler. An important ingredient also when you think of urbanization in Africa, we've got rolling slums growing in many of the capital cities, means that we've got a lot of informal housing in the urban areas. And again, it's trying to understand what mechanisms, at least from a capital perspective, are available to address the informal housing needs, considering that the bulk of the urban dwellers, 60 to 80%, will actually be involved in some form of informal means of employment and hence are not able to have the financial means to access formal housing finance like mortgages. That is the context in which we are delivering today's webinar on housing microfinance. As Tandiwe had mentioned, this is a three-part series. Today, we're really going to focus on Housing Microfinance 101, the basics, to build the foundation. Next month, in June, we're going to go into a bit more of the technical elements on how it is that you actually make housing microfinance work. What makes a housing microfinance product? What are the institutional infrastructure and resources that you need to have to operationalize housing microfinance? And then in the third webinar, we'll be looking at how it is that you scale. So you might have a product, it's operational, but how do you scale it to ensure that we are contributing towards solving for the housing finance gap and ensuring that also that there's a solid business case internally for your financial institution to be involved in this offering. So as we engage today and you look at what it is we'll cover and what we might not cover, bear in mind that this is a 3-part series and that today is part 1 of 3, looking at the basics and introduction. And then in the next 2 months, we're going to go into some of the more practical operational elements and how it is that we scale to ensure that we've got a business case for a financial institution that decides to go into housing microfinance. I've touched a bit on the African challenge when it comes to housing finance. We will then spend a few minutes to unpack what housing microfinance is, defining it, the scope, what it is and what it isn't, the type of institutions who are involved in providing housing microfinance, both from the provider perspective, but also the clients, who are the users who actually do need to access housing microfinance services. And then the latter part, we'll be looking at the strategic case for why housing microfinance actually becomes essential and relevant, and close with a Q&A and reflection session, which my colleague Stephen will facilitate for us. So as I had mentioned, with regards to the housing gap, there is an estimated 1.5 households that will need to be housed by 2050. Building these houses will require significant capital. Capital which cannot be generated from income alone, hence we look at debt financing. We've also established that from an affordability perspective, only 5% of households can actually afford a mortgage. So where does this leave the 95% of households who need to also provide financing for their households? Houses which are actually going to be built through incremental self-built mechanisms, which makes this type of self-built incremental building ideal for housing microfinance, and we'll try to look why that becomes such a fit. Then adding on to that dimension is the high urbanization rate, which has led to a significant number of informally employed, self-employed people in the urban areas, where the demand then becomes very significant for us to solve the housing gap in the urban areas in Africa, where the sources of income and the economy tend to be highly informal. What does this mean then for financial institutions? We've said mortgages as a strategy only leaves significant number of households unserved. So we need to look at an alternative type of service other than a mortgage, other than a bond, to increase or make it possible for 95% of the households, informal households, to be able to access the capital required. Incremental housing becomes an option which has been successfully tested, and we've got multiple institutions across the continent. However, there is opportunity for more financial institutions to enter the housing microfinance market. And this ensures that then that we're able to solve for the challenges of mortgages related to, for instance, issues of affordability and the lack of appropriate collateral. Incremental housing that I referred to basically is referring to the most popular model of building of houses on the African continent. With the bulk, if not all of us, being based in Africa or being African in our different communities, whether it's in the urban areas, in the rural areas, we all know that houses are not built in one phase or in one shot. What usually happens is an individual would purchase the piece of land, the plot, having saved enough resources to purchase a piece of land. After a couple of months or years, they'll go through the process of just laying the foundation, resources permitting. Possibly over a period of 2-3 years, they'll move to the next phase of building up the initial structure or the walls. In the next phase, they'll look at beginning to add finishing touches such as the roof, the fittings, whether it's the windows, and electrification. And finally, you look at services, whether it's water or electricity and sanitation. So this is the typical model for building a house across the continent. However, most of this takes so long because individuals have to rely on their limited sources of income, predominantly through savings or having to borrow from informal sources. Hence, housing microfinance, which is really the provision of small loans, anything ranging from $250 to $5,000 over a relatively short period of time. We're talking about 6 months to 60 months. So repaying a $250 loan from anything from 6 months, and for a $5,000 loan up to 60 months, and using these cycles of loans to finance these 4 to 5 phases of building a house. This is really where the incremental housing model and affordable housing and housing microfinance come together. It gives us the capacity to be able to build a house over multiple cycles of loans because the loan values that are required are small enough to be afforded by the low-income household, and also at the same time allow the house to be built in different phases. So this model becomes then very well suited for the African context, where income levels do not allow for individuals to afford a mortgage, also where the land tenure elements, security of tenure, or title deeds that are required for collateral would not be available to rely on. Hence, making the mortgage, the traditional housing financing mechanism, inappropriate for the socio-economic context of Africa. Hence, looking for models that are better suited for the incremental housing building approach that is adopted across the continent. So if that's said that housing finance is an ideal model, what exactly is housing microfinance? And maybe even before I go into that, I would maybe want to get a sense of, before we define housing microfinance or affordable housing, how many of our participants actually do have a housing finance product offering in their portfolio. Stephen, are you able to pick that up from our poll, just for my context here so I don't get out of my screen? So it would be ideal to get a sense of how many of us here can actually relate to housing microfinance because you already have an affordable housing product in your portfolios or in your service offering.
I have the poll results on my screen. I'm not entirely sure how to change them, how to put them somewhere else. So let me.
Oh, if you could just tell me a sense of the percentage, Keisha, between yes and no, we have an affordable housing product in our offering.
So 43 people so far have answered. There are 71 people in the room. 43 have answered, and a third do not have an affordable housing product, and 2/3 do, which is really exciting. I'd love to know about those products.
I think we're going to flip this webinar. Maybe it's going to be a discussion and not maybe so much as me sharing our perspectives, but maybe hearing from everyone, since there seems to be quite some decent level of experience in the room.
And lots of people are answering in the chat as well. Yes, no, yes, no. So now we can even see who it is.
Okay, perfect.
Yeah.
So when we come to the reflection, I think we'll be really keen to share from your experience and perspectives relative or contrary to what I'll be sharing over the next few minutes. So I think for us to go deeper in our discussion, it would be important to have the same or similar understanding of, when we say housing microfinance, what we are referring to. So literally a textbook description of what housing microfinance is, which I love, from the Housing Microfinance, A Guide to Practice, written by Daphne and Ferguson some almost 20 years ago now, that still remains relevant to today. It describes housing microfinance as any microfinance tool to support investment in the components of housing, including land purchase or access, provision of or improvement of services, full or incremental house construction, renovation, or maintenance. So as I was outlining a few minutes ago on what incremental housing is, housing microfinance is any micro, meaning small value loans that can be used to finance any of those steps in the cycle of incremental self-built or renovation and improvement to a housing. So a financing mechanism, small value, microfinancing mechanism that can be used to finance the construction, upgrade or improvement to a housing or domestic dwelling. However, especially if for people who might be coming either from, especially from a financing perspective, either microfinance or banking and mortgage sector, it always helps to frame housing microfinance relative to what a mortgage would be in the formal housing finance perspective, or relative to what housing microfinance is compared to micro enterprise lending in your traditional microfinancing context. Because housing microfinance sits as a subset between these two different financing services, with mortgages being obviously formal housing finance focused, coming from regulated formal mortgage companies or commercial banks providing mortgages and bonds. And then on the other end, you've got microfinance, which traditionally provides financing for micro small businesses through group lending, sometimes individual lending. Looking at bringing the best of these two different services or technologies, housing microfinance sits right in the middle. When we try to compare then these two, we find that in housing microfinance, we are targeting low to middle income earners, predominantly through informal means in which they earn their income, meaning they'll be self-employed, meaning they are not able to provide the pay slip or proof of income that is required for a mortgage or traditional access to credit for a bank. That is an important definition to understand which sort of market segment housing microfinance is able to serve. From the provider's perspective, again, on one end, for mortgages or bonds, you've got your commercial banks and mortgage building societies on one end. And when it comes to microenterprise lending, you've got microfinance institutions, SACCOs, and sometimes non-banks. But what is important here is that this is a segment or service providers who would typically be providing financial services to people with informal sources of income, or which they are not able to support with a payslip. So housing microfinance, again, is well suited for other type of financial institutions other than the commercial bank or the mortgage company, as a means of them being able to service their same informal client base, but for the purpose of providing capital for self-built incremental house building. The tenures of the loans, again for housing microfinance, will be longer than a traditional micro enterprise finance loan, which tends to be up to 6 months, but will be significantly shorter than your traditional mortgages of 10 plus years. So in housing microfinance, we are providing loans ranging from 6 months to 60 months on average. And this then also implies that the loan values can also vary from anything as low as $250 equivalent to $5,000. This range and the tenure are all addressing the affordability question, meaning that the person accessing the credit is able to afford a $250 loan to be paid anything from 6 to 12 months on the basis is that that is the level of income that is the type of repayment that their level of income is able to afford. So housing microfinance is allowing us to mitigate the risk of providing a high value loan for a longer term, which is unsecured, and also where we do not have sufficient visibility on the affordability and stability of income of the borrower. Even more important is that for housing microfinance, this tends to be unsecured, or we look at what are called alternative or substitute collaterals. We are not looking for title deeds in housing microfinance, or even land title, because if that is a criteria, then we are not going to really move the needle with regards to increasing the number of clients who can actually qualify. So we do not lend on the basis of collateral in housing microfinance, in part because we are mitigating the risk by the loan sizes being smaller and also being paid over a shorter time, leveraging the same concepts of microfinance, for instance, using group lending as a way of safeguarding the loan, because the members of the group who are borrowing the loan actually get to co-guarantee themselves. So important here to think of housing microfinance as really sitting in the middle of traditional micro-enterprise finance with the different methodologies used there, such as being able to lend without collateral through group lending methodology, but also taking some lessons from traditional housing mortgage financing, that the main purpose that we are lending for is really to ensure or access to capital for self-built incremental housing. Most also important here is that for housing microfinance, because we are not lending for income generation, as is the case for microenterprise lending, the affordability or the ability to repay the loan is based on current income and not necessarily projected future income. There are exceptions to this approach, which you consider at the time of designing the product, but it's important to recognize that in housing microfinance, unlike, let's say, compared to microenterprise lending, you're not necessarily banking on the asset that is being financed, in this case, the house, being able to generate income in itself. So just again, in summary of the last 5 minutes or so, just to clarify exactly then what it is that housing microfinance, the main elements compared to enterprise microfinance or mortgage financing is that you are actually financing an asset. That is the impact that you're having on the client. It's not that you're generating income, but that you're building an asset over time through small value incremental loans which could be anything from $250 to $5,000 equivalent over multiple cycles, so that you're able to build or upgrade the dwelling over time. While a typical microenterprise loan financing for a small business is 3 to 12 months, your typical mortgage, formal mortgage, is minimum 5 to 30 years. Your housing microfinance loans sit right in the middle of that. The repayment capacity is based on assessment of the current income. An exception in this is that there are times when housing microfinance can be provided to an individual for a household because they are building an additional dwelling to which they want to rent out for income. That is a context where then you can take into account future income that would be generated from the asset that's being financed in terms of trying to understand the repayment capacity. Collateral, as I had indicated, in housing microfinance, you look for collateral substitutes. You're not lending on the basis that the client is going to provide you with a title deed or some form of other secured collateral. Borrowing from the principles of housing microfinance, we use what are called collateral substitutes, in particular, where you could have members in a given community who belong to a group actually being able to co-guarantee the loans that they receive, even for housing microfinance purposes. And if you're talking about low value loans of $250 payable over anything from 6 months to 36, the group lending methodology lends itself well because of the value of the loans. And if we are talking about building over multiple cycles of loans. And again, to emphasize that with housing microfinance, especially considering that there is the social impact that we are trying to contribute towards, or increase of inclusion, is that the focus group tends to be low to middle income, those who would otherwise not be able to access a mortgage. And they would tend to be self-employed or from the informal sector, micro-entrepreneurs, as opposed to individuals who are in the formal sector, are able to show proof of income with payslip over time. So this identifying the market segment of housing microfinance, you understand that we are really then increasing the market coverage of households or individuals who can afford to build their house over multiple incremental loans. And just to, again, make the point, as I said, when we looked at the African context, that then housing microfinance becomes significantly well suited for the African context, where income levels and issues of land titling become a barrier for us to rely on mortgage financing as the main mechanism for financing affordable housing. I'll spend the next few minutes now just for us to look at a few examples to make it a bit more relevant in terms of institutions across the continent who are already providing housing microfinance and the profile of a typical client accessing housing microfinance. Existing financial institutions who are actually working with self-employed micro-entrepreneurs, working in the informal sector where you've got economically active individuals but have got irregular income and are already clients of MFIs or SACCOs, become very well suited to potentially access housing microfinance. So these are individuals who already have proven their capacity to generate income. They are already loyal clients, customer base of MFIs and SACCOs. This is the market segment then who housing microfinance becomes especially well suited for. Even more important is what happens is micro-entrepreneurs who are clients of MFIs and SACCOs, they too have significant housing needs. In a situation where the MFI or SACCOs does not have a dedicated housing microfinance product, you'll find that their clients end up borrowing their microloans to fulfill their housing finance needs. But these products are not sufficiently well structured to meet the housing finance need. A case in point is probably the tenure of the loans, as I said, for micro enterprise finance tends to be anything from 3 to 12 months, which means the loan values will be significantly lower and might be suitable for a micro business, but not when you're financing in an asset such as purchasing your first plot, putting a foundation. So MFI is already servicing the economically active, but with informal irregular income, are well suited to increase, to provide housing microfinance to the existing client base. This is one segment where housing microfinance becomes significantly important because this is economically active individuals who suit the African context very well, where we've got MFIs and SACCOs being some of the dominant providers of financial services across the continent. Similarly, with a second profile of informal sector workers These could be smallholder farmers, artisans, or traders running small businesses, and who already are credit worthy because they have access to credit in the market, but it's not backed up by a payslip. This fits the context of the majority of African households, especially in the urban context. So they do not have a formal income backed up by a payslip, but they're economically active and they're able to show that they're credit worthy through the cash flow, which they would already have from different services that they access. So this becomes an important market segment again, where housing microfinance is well suited to contribute to addressing the African housing challenge. By extension, it's really, as we said, that the dominant or the most prevalent challenge is tending to be in the urban areas, where population densities are leading to the fact that the housing stock available is not sufficient enough to meet the demand. Even more so, because of the population densities, the sort of housing that is required in the urban context tends to be also quite rudimentary. We're talking about rooms to rent in the backyard and not necessarily having to access financing to build formal, full structures. So low-income urban households are able to really contribute towards a housing challenge through rooms for rent, through extension of backyard rentals. And this becomes quite suited again as a segment to focus on or to target through housing microfinance, because it's really around extension of some of the already existing housing stock to increase affordable accommodation at relatively low cost through incremental housing. So this just sets more of a spectrum of in terms of the different portfolios or profiles that are well suited to be targeted for housing microfinance, especially for financial institutions who are trying to define the target segment who would be suited to reach through housing microfinance. With regards to the profile of institutions that are well suited to provide housing microfinance, by virtue of the example I made in terms of microenterprise lending versus housing microfinance institutions, of which there are thousands across the continent, are well suited to go into housing microfinance, especially as a means of diversifying to serve their existing clients, but also as a means of expanding their market to serve a different market segment. We've had the opportunity of working with many institutions in this context, and we'll be able to share with this, if not today, definitely in subsequent webinars with Stephen, of institutions, MFIs in particular, where they have entered the housing microfinance space as a means of diversifying their offering to the existing clients or to serve a new market segment altogether. And on the right-hand side there, we've got many MFIs across Kenya, Tanzania, Uganda, very common names, the Juhudi Kilimo, the Thinker Network, Opportunity, Letshego, present in many African countries, and in some of them, at least in the case of Kenya, these have been some of the pioneers in providing housing microfinance. Beyond the first segment, which talks about really strong MFIs, we also have maybe what you'd call tier 2 microfinance institutions, meaning these maybe might only provide credit, they don't have savings, or SACCOs. By virtue of the fact that they're able to also mobilize savings, this means that they've got access to relatively cheap capital that they can provide as loans to their existing clients, as opposed to non-regulated MFIs that are not able to mobilize savings, hence would not afford the capital to on-lend. Regulated MFIs and SACCOs are well suited to go into housing microfinance because they are able to mop up or utilize any of their excess liquidity from savings as capital, and allowing them actually then to have a balanced balance sheet. Commercial banks that are looking to enter the lower income market segment, then also have an opportunity to enter microfinance through a housing microfinance product. Commercial banks tend to view the informal sector or micro enterprise clients as high risk, but housing, because there's a tangible asset, is also perceived as being relatively lower risk than micro enterprise lending. So commercial banks also do go into the microfinance sector by testing the waters through housing microfinance. And again, we have examples, some institutions that we've had the opportunity to work with, including Housing Finance Bank in Uganda, NBC in Tanzania. These are commercial banks who've downscaled to actually enter the affordable housing space by developing housing microfinance products. And then because of the social impact nature of affordable housing microfinance, they are specialized housing financial institutions and NGOs who work broadly, not only just through the access by providing capital, but in partnership with financial institutions, with local authorities, ensuring that access to, for instance, affordable land. These are NGOs, work with other partners, work with financing mechanisms such as group savings to ensure that housing microfinance then can be used to serve low-income market segments. Sometimes they work with the public sector where subsidized funding can be provided. But all in all, they are specialist housing finance NGOs and international networks that work with local financial institutions, local authorities to provide beneficiary communities with access to housing by facilitating housing microfinance initiatives also. So this just provides a spectrum of who the type of providers are and at what point they can serve which different market segment. And finally, before we can go into, I think, a discussion, and as we indicated, really wanting to hear from you, what is the strategic case for housing microfinance? Why does it even become necessary? This is rehashing some of the themes that we've already presented on. But a significant consideration of why housing microfinance is really necessary has to do with affordability and the cost of constructing houses, meaning it's not possible based on the income levels of 95% of households to access the full capital, the full loan required to build the house in one go because of the high construction costs, because of the low income. So hence incremental housing, which housing microfinance is able to facilitate becomes essential and critical because of the issues of affordability and construction costs. Secondly, prevalent across the whole continent is the absence of secure land tenure or legal rights, which allows one to confidently claim the rights of ownership to a piece of land or the house. This means that land rights, property rights, are not strong enough to be used as a basis for formal lending by banks. So in this regulatory or legal context, other mechanisms do need to arise. Hence again, housing microfinance allows financial institutions who are able to lend with the right mechanisms in place to do so without having to rely on collateral that is secured due to the absence of secure legal rights and tenure. With regards to the third element around financial constraints, to provide long-term capital in terms of mortgages, 5, 10, 20, 30 years, the financial institutions that are able to do this, the commercial banks, have access to long-term capital, which is stable. Not so many, other than the leading commercial banks in most of the countries, not so many financial institutions have access to affordable long-term capital. Hence, it's not the capital markets are not strong enough to have many institutions providing mortgages. However, short-term capital, short-term financing, 6 months, 5 months, is most suited for the market context for most African countries where there's foreign exchange instability or currency instability. The exposure is mitigated by the shorter terms of housing microfinance as opposed to mortgages. Then a fourth component also has to do with infrastructure gaps, where the delivery of bulk services is really non-existent in most of the African countries, even in the capital cities. And in the absence of bulk services, and where then individuals rely on self-built incremental housing microfinance tends to play a role in that, since you find that it's the individual who's having to solve also for their utility services, as opposed to in a traditional formal development housing context where the bulk services are delivered on site. Here, the individual needs to provide that as part of their incremental housing. So again, the absence of infrastructure, bulk services, is another reason which makes a case for where housing microfinance tends to be a suitable alternative for addressing the housing challenges. From the financial institution perspective, housing microfinance becomes important as a means of diversifying the portfolio. Whether you're talking about an individual microfinance institution whose clients basically are involved in micro enterprises, micro businesses only, or are involved in smallholder farming, to mitigate the exposure, it's ideal to have a diversified portfolio, such by introducing housing finance. So for many institutions, and as I mentioned, especially let's say for those which are involved in savings mobilizations, having a product which has got different maturities from their traditional micro enterprise loans is suitable in terms of diversifying the risk of their balance sheet. Similarly, for a commercial bank, for example, that is looking to downscale, having your portfolio exposed or diversified not only from the formal employed sector, where sometimes you have economic shocks where a whole sector might be affected, and if a bank is overexposed to that, having a diversified portfolio, because you also have a client base of housing microfinance clients from the informal sector, makes for a more robust balance sheet. When it comes to microfinance institutions who have been involved in microenterprise lending, introducing a housing microfinance product contributes to client loyalty and retention, especially when you consider that you're saying a housing microfinance, you are building your house over several cycles of incremental loans. So this really allows one to have traction with clients over multiple cycles of loans, and retains clients who tend to be more loyal, as opposed to, let's say, micro enterprise loans, which could be once off. So both from a portfolio diversification and for a client retention perspective, housing microfinance becomes an important addition to an institution's product offering. With regards to revenue generation, housing microfinance also is able to generate relatively higher yields on the basis that it's a long-term product. So the cost of delivering one loan, which is going to last 5 years, is relatively lower than having to originate a 6 months loan every 6 months over the same 5 years. So from a revenue generation or efficiency perspective, housing microfinance would tend to be more profitable than micro enterprise lending. A similar argument could also be made with regards to, let's say, mortgages versus housing microfinance for a commercial bank that might be downscaling. In terms of mission and impact alignment, for many impact investors or even commercial banks who also have a social mission, housing microfinance by its very nature contributes towards social upliftment on the basis that it's inclusive and you're bringing into the housing market individuals and households who would traditionally not be able to afford. Not to mention also the unmet demand within the portfolio that the traditional clients of a bank, a SACCOs, or an MFI will inevitably have housing needs. So if this is a need that is not met by the financial institution providing the other basic services, either they'll go elsewhere and access the same financing at a higher cost informally, or their access to decent housing is going to be deferred. So there is always an inherent demand for housing financing in the portfolio of any existing financial institution. Then with regards to ecosystem positioning, a lot of housing microfinance institutions have been able to go into this in parts by ensuring that they're able to serve the housing needs of their clients, but also because housing microfinance is able to attract concessional developmental lending from DFIs. In addition to that, technical assistance to allow the institutions to actually implement the new product. Being quite conscious of time, this is just a summary slide again comparing housing microfinance to conventional mortgages with regards to the sort of client that we're serving and the type of income they have, the tenure of the loans, the collateral or collateral substitutes that are required, and also the profile of the market segment that we're serving, that this tends to be low to medium income households, and that there's really the unmet demand that 70% plus of households do need or would qualify for the services that housing microfinance would provide, as opposed to only 5% being able to qualify for conventional mortgages. At this point, I'll hand over to Stephen to share at least one case study or so of a real case of how housing microfinance can actually impact on one's household. And then we could be keen to hear from some of your experiences or any questions and clarifications you would have. Over to you, Stephen.
Bezant, maybe, sorry, Bezant, maybe while Stephen takes us through these cases, you can browse some of the questions in the chat. There's some nice ones.
Yes, I've scanned through, Kesia. I've noted.
Okay, very good.
Yes.
Over to you.
Okay. Thank you. I'll just take you through a client's journey. And one of the key things that needs to be very clear that housing is a journey. And why is it a journey? Because we have a constraint, which is income. A person, it's not that they will not wish to have a house at once in one flip. No, it is there's a constraint of income. So with that constraint, how best can they do within that constraint of limited income? This is a case of a client, as you can see the first photo. That is the client, that's the house she was living in here in Kenya. This is a farmer. And the house, as you can see, the state was not very nice. And the microfinance institution that we were supporting was able to give this client $600. From $600, you can see the second photo, the third photo, and the fourth photo. That is the house she has been able to build. Somebody will ask, with $600, you cannot build that house that is number 4. That is our understanding. But clients have a plan, and they're only needing a little boost. This client has been saving in a hardware shop where she has been saving for cement, for the materials, for the ballast, the sand, all that she has been putting on site. So she only needed $600 equivalent to have done that house that you can see number 4. So if we understand housing is a process, then we'll come in at the client's point of need and actually actualize their dream. So this is a very live case of only $600, and you can see the impact that the $600, somebody will think this client was given $10,000 from our thinking. But practically on the ground, things are different. So we only need to understand what the client's needs are. And we design products that match their need at their particular point in their housing journey that they are in. So just before we jump onto the Q&A, that in most cases, you will always, from the market research that I've done across Africa, we will always imagine that if we are solving a housing problem, we will think housing will come priority number 1. No. Housing comes priority number 3 or number 4, the last on the client's need. So if it comes number 3 or number 4, does it mean we don't need to support clients? That's not the answer. The answer is we must understand housing has to be anchored on livelihoods. What are the target client doing? So if you are not supporting the livelihoods anchor, you will find housing will not thrive. So you don't focus on, because your focus is housing, you only deliver houses. You must be asking yourself, where is the income that this client is to pay that home improvement or that house that you are putting up? So that is one consideration, that when you get into the housing microfinance space, you must have also an intentional livelihood intervention that you must also be running. And also, housing microfinance is not, we are saying that housing does away with mortgages. It complements mortgages. And for most of the institutions that we have worked on across the continent, some of the housing microfinance clients have ended up being clients for banks, because they have built an asset of which now the bank will come and take the security as a sole form of security. So housing microfinance, cooperatives and microfinance institutions are building assets of which tomorrow will be an asset on which the bank can lend on, because banks lend based on the security and the title, and which microfinance institutions are building that. So housing microfinance and mortgage lending, they complement each other. That's a very important point that we have to take note of. And in the housing microfinance, is always very important, is a numbers game. So in most of the institutions that we have supported in Tanzania, in Uganda and Kenya, the average numbers of loans that most of the institutions are doing is an average, the big institutions are doing an average of 10,000 loans a month, which is the average loan size of between $800 to $1,000. So when you work out that math, you will find that number, no mortgages institutions are giving that big ticket sizes. So it's a numbers game. When you get into it, you must have the right product, and the numbers you will get with ease. And just on another aspect, that a product is very, very important. And one of the aspects that has made institution or clients not have, institutions not having this product, when a client says he wants a housing loan, one of the misconception we have always looked at as a mortgage. So we ask, do you have a title? Do you have a pay slip? And that puts off clients. Then the client will always say business expansion. What are they expanding? They're expanding their houses. And you'll find researchers on 20 to 30% when you look at all, even the unsecured loans in commercial banks are actually doing housing development when we follow through. So this practice is happening even within commercial banks, microfinance, within the whole financial sector. It's just that when we mention a housing, we ask for the impossibles, and the clients become smart and say, I just want to do a personal development. But the personal development in reality is housing development. Just to move to the 3 questions, then I'll open the floor for people to ask questions and clarifications. The first 3 questions from Maureen. She asked, is the problem getting into housing microfinance, is it a capital problem? I will say no, because one of the aspects that I've just alluded before, that in most cases, there's always a misconception between housing microfinance and mortgages. And people always think that when you get into housing, you must have money that can go for long tenures. And as you realize, most of the institutions, their loan tenure is actually an average of 2 to 3 years, which is just within most of the enterprise loan that most of these institutions they are providing. So capital is not the issue, but just having the right product is where the mismatch lies. There's a mismatch with what the client wants and what the institution is having, conceptualizing, thinking is because it's housing, it has to be long tenure. So it has to look for long tenure funding. Then that causes a mismatch, and hence the institution don't venture into housing microfinance space. So liquidity is not an issue because currently, as you look at the loan sizes, they are not that outrageous. So within the same funding that you are receiving, they still can fund housing microfinance because clients will want to finish the first phase, move to the next phase. So they also will not want to wait for long periods because they also want to finish the house and to be able to move in. And the third one that you raised was on the PAR, that what is the contributing factor that is driving poor asset quality? And Bezant, it's good you've raised that. And from my experience and working with most of the institutions, one of the aspects that if an institution is struggling with their current business, is always a nightmare to venture into any new product design. So it tells you that the institution's model of lending has some gaps and will require to be fixed before venturing into new territories, which yet the institution will also take time to understand before venturing into. So one of the aspects is most of the institutions have more focused on values, but not on clients' needs. And when you are not addressing clients' need, that will be tantamount to leading to the clients not paying your loans well, from my experience, what I've seen. So matching the client's needs is very, very important because the client see you are serving a need. But if you are only focused on values, but when you talk to the loans officers, they don't talk about products, they talk about my target is to give out so much, but not what is the solutions of products that we are offering to this client. You find that is where the mismatch is. Thank you for just those three. Then the next question is considering the large informal sector, how can housing microfinance better assess credit worthiness beyond the traditional banking models? And from the aspect that Bezant alluded, for you to venture into housing microfinance, you must be good at enterprise development, because it's through the enterprise development is what will make housing microfinance sustainable. So if your model has leakages, it calls for fixing that before you venture into housing microfinance, as you know, it's not going to increase on income unless the client was living in a rental house, is moving into his own house, and what is going to save as a rent moves towards payment. So understanding what the impact of the housing has on the enterprise becomes very, very important, and requires how well the institution has streamlined its whole appraisal system that currently is it working for them or not working for them. If it's not working for them, if they venture into housing space, and this is more or less like consumption loan, it will have an impact on their overall business. So perfecting what you are doing currently becomes very important and becomes very non-negotiable. You perfect on what you have been doing previously well. Then
if maybe just to add on that one, though, I think you've already made the point that it's related to the underwriting process for the financial institution. So with traditional banks, the reason why they would not go, or they would challenge to go into housing microfinance is, as I'd alluded to, the banks tend to lend on the back of collateral. But here we are saying that from microfinance, you use alternatives such as, at a very basic level, it's a group lending where members in a community will co-guarantee each other. So yes, we're talking about low value entry loans, but the group lending is just one example of where MFIs use to lend without collateral. The alternative is really cash flow based, where again, microfinance institutions are not going to lend on the basis that you have a title deed, or you've got a letter from the chief who says that you own the land. They are going to have their loan officers go into the community and understand the performance of your micro enterprise, a business. That is the basis on which they would lend for the business. But as Stephen is saying, that at some point when the business is thriving and the client now wants to focus on their housing, it's this same risk assessment that would be used. But this time around, we are saying that it needs to have then the right type of product, because you understand that the money is not going to be used for the business anymore, but it's going to be used for construction a house, which maybe will mean that a few months down the line, this client is no longer having to pay rent. And this is now income that is saved and can go towards servicing the loan. So from the risk mitigation, not to be dismissive of banks, forget about anything that the banks use in terms of assessing the risk when you're talking about housing microfinance, in particular because the income assessment and also the underwriting in terms of collateral is completely different. And we will be able to go into this in a bit more detail. I would be keen. I think that we're trying to answer some, but maybe not all the questions. Is there anyone who would want to unmute and maybe voice their questions?
Bezant, I want to direct you to a set of 3 questions that were made by Maureen Katuvesiaruna from the IFC. You scroll up a bit to
That was right at the start, right?
right at the start. Yeah, I just thought you might want to speak to some of the investment issues.
I think
She
that's gone too
says,
far.
is capital truly the binding constraint for HMF, or are there other factors at play? I understand liquidity is not an issue for MFIs, so what are the genuine funding gaps? And could de-risking instruments help address them? And lastly, what is driving asset quality deterioration among MFIs, presumably those offering housing microfinance, and how are institutions responding?
So let me try to address all 3, especially the first and second one. Around the capital, is capital truly the binding constraint for MFIs? It depends on the context. Related to first does the MFI have access to its own capital because it's a deposit taken or not? In that case, then the cost of capital is less of a challenge if it's deposit taken. However, if it's an MFI that needs to rely on loans or bonds from third parties, the issue then usually tends to be that the capital needs to come from in hard currency. So foreign FX lending into Africa is always a challenge because you're borrowing in dollars and then you're lending in shillings or you're in kwacha. So that mismatch, it is a genuine challenge for institutions who are not lending off their own balance sheet. If they need to borrow, lending in local currency is very rare, with the exception of a few entities I can speak to. I talked of the organization I work with, Symbiotics. We manage a few funds where we lend in local currency. And it's precisely to try to mitigate that cost of a microfinance institution having to borrow in euros or US dollars, then lend into local currency. So there is a genuine constraint on liquidity, depending on the country and depending on the specific institutional context, on whether they are able to mobilize local savings or local or wholesale lending. So it depends, I guess, is my answer. But yes, liquidity does still tend to be a challenge in some contexts. I want to jump onto number 3. What is driving asset quality deterioration amongst many MFIs? How are institutions responding? Again, it depends also on the MFIs. Some have got diversified portfolios, meaning they're not maybe overexposed to a specific industry such as agriculture. What's happening to a number of institutions, and I can speak with confidence again because we provide debt financing, is that since it sounds like a cliche, but since COVID, most institutions have had very haphazard performance. Some of it has to do, let's say in the last 6 months or so, just with unstable cost of energy in many countries. That is affecting then the port. When cost of fuel goes up in most countries, it's got a ripple effect in the whole economy, even for micro enterprises. This is rearing its up in the quality of portfolios of some of the institutions. Some of the extreme weather that has been experienced in some of the countries in East Africa, for instance. Again, 5 years ago, when we talk of climate change, it sounded remote. But now we do have MFI portfolios being affected, whether it's by floods or drought. And institutions then are having to, how institutions can tend to respond is precisely, for instance, where Housing Microfinance could also help if the portfolio is slightly diversified. Because we're saying if you have a Housing Microfinance product, probably you're not only going to be servicing clients with one economic activity. It's a need that cuts across. So institutions are responding differently depending on what is causing the deterioration of their portfolio. Stephen would be able to confirm one institution we've supported in Kenya. They have precisely gone into housing microfinance to try to address their portfolio deterioration because they want to diversify their portfolio. So institutions are responding differently. One would be tempted to say, oh, because the portfolio is not performing well, we might not want to go into new products. But it would be important to understand what it is that's causing the deterioration of the portfolio. What is essential, and we will go into this in webinar 2 or 3, is that while housing microfinance can be done successfully, there are few prerequisites. You need to have, the institution needs to be robust before you can introduce housing microfinance. And understanding any deterioration in portfolio was important before you introduce a new product. De-risking mechanisms. Maureen, it would be great to understand maybe which ones you would have in mind here, especially if it has to do with the funding gaps. A case in point is without having to go too much into micro build. The micro build fund is like you've got different. If we could have dedicated, or saying around de-risking instruments, what makes all the difference? I'm saying de-risking mechanisms would include, for instance, having dedicated funds for housing microfinance. There have been some in the past. I was referring to the Microbuild Fund, which was promoted by Habitat a couple of years ago, and there's a new Microbuild Fund which is in the works. It does have inbuilt de-risking mechanisms. It does have technical assistance embedded in it. So those are some of the initiatives that can definitely be used to de-risk housing microfinance. Just not the capital, but it's the pricing of the funding and also a value added such as technical assistance, which can make all the difference.
I'm going to invite Machimere to ask your question. Machimere Nwaneri. Please go ahead.
Yes, hello. Good afternoon. Can you hear me?
Yes, we can.
Okay, so thank you. I'm sorry I joined a bit late. I need to.
Oh, we've lost you. Try again.
Can you hear me now?
Yep,
Yes.
we can. Go for it.
Okay, I said before I go forward, I'd just like to know if there would be a recording forwarded to our emails or something.
Yes, and it'll be on YouTube.
All right, thank you. Then the second thing I'd like to ask, which is the most important, is will the HMF program only be targeted at clients? Because when I listened to Stephen, it seemed the example he gave was of a client who was building. So I didn't start from the onset of the entire meeting. But I just need to know if the program is only targeted at clients who are building from the scratch. Because I'd like to know if there is a place for housing developers who are interested in helping prospective clients to own homes, because I work with a company that believes in the housing initiative that everybody deserves to own a home. So we just want to know if there is a place for people who want to purchase homes, not necessarily build from the scratch.
So we take a few questions, Bezant.
Sure.
Yeah, okay. Obed, would you like to unmute yourself and ask your question, and then I'll come to you, David. Obed, please go ahead.
Yes, thank you, and good evening, everyone. My name is Obed Rono from Juhudi Kilimo. My question is if we will get a platform where we will speak about the client stories, because we are doing so much in terms of housing, but it gets lost because these stories are not spoken about. Secondly, is I've participated in product development, product design, enrollment, until practical implementation. True. But one thing that is a big challenge is the diversion that comes after funding. Clients maybe needed to do something and they divert funds. So that's one other issue. The last thing I would like to respond to is a question on deterioration of quality in microfinance. One thing that is happening, for example, in my country, Kenya, is the microfinance policy where loan guarantee fund was abolished. So you are giving just a loan plainly without loan guarantee fund. One other thing that is happening is multi-funding in the sector. The same client being loaned by multiple institutions, that is also affecting quality. Again, there is also funding directly in microfinance without considering training, which is also a big issue that is coming up across. But from my experience, I have worked with Mr. Wanjala in product development, product design, up to implementation, and I can confirm that this is a very good product that, if adopted, would really help in housing development. Thank you.
Great. And we're running out of time, so I'm going to quickly ask David to issue his question, and then the two of you can respond. I'm going to stop there. Dicky Lady, I'm sorry. Please put your question into the list, but here you go ahead, Bezant and Stephen.
Okay, if I may go first around if this product or program could be used also in collaboration with developers, or is it only appropriate from scratch? The beauty of housing microfinance, as Stephen had indicated, is it's modular and it can fit in the different contexts in terms of the life cycle. While we were making the strong case of how housing microfinance makes an entry point from somebody starting from scratch, it can be used for renovations, for upgrading. With regards to whether is it a good fit to use housing microfinance for financing of a development through developers, yes, but it depends. It would come down to probably having to get into some form of strategic partnership with the MFIs, and there need to be an MFI. It could maybe then even be banks. What would be important to consider is what is the total value of the house that is being financed by the developer? Is it really low cost affordable housing? Because if not, then chances are it's still going to be too expensive, even if the intention is to use housing microfinance principles, meaning low value loans over several cycles. Because we are saying probably at the very most over 5 years, you would probably only still be able to pay 10,000. So the issues that you're working through a developer, there might be a margin involved as opposed to self-built, but it will come down to identifying the right financing partner. It can be used to really integrate into financing for a developer, but it would strictly not be fitting the housing microfinance as we've defined it in this context, because the main issue being the cost of the asset being financed will probably be significantly high and affordability challenges would arise. Around client stories, Obed, we can explore, especially for webinar 3, I think, where some of the client stories can be showcased from participants. Though I would like to add, Stephen would confirm that the slides that we have there, this is actually from a Juhudi Kilimo client, one of your clients, in terms of the $600 loan that we referred to, which led to this house. Stephen, you want to address the remaining questions? Yes.
Yeah, I think just on the developer, I think I think we removed a slide. I think which I think she was referring with the builders. I think that aspect of micro mortgage, which is between housing microfinance and the traditional mortgage. So there is another product which I think with the developers, that is where now the micro mortgage could come and fit in. So it all calls for, before the developer, which is the supply driven, the housing microfinance starts from the demand before now you think of what are you going to build. So it is reversing the traditional way of delivering housing, but starting from the end user and seeing what do they want, what do they plan, and what can they afford. So it's just flipping around, but it can be explored. Thank you.
And not in time, very quickly, I think to one of Obed's questions around, I think it was diversion of funds. How important is it for the MFI, whether if the client diverts the funds or not? One way in which we address this then is you do not finance the capital or the funds, but you finance maybe the materials through partnership with suppliers. That is one rudimentary solution where the MFI goes into partnership with suppliers, and that reduces the risk of diversification. But if a client did not intend to build, it's a fund they wanted to access, they'll still find means. They'll get the materials, go and sell them almost at penance, and still not use it for housing. So it comes down to what was the needs assessment in the first place to establish that there was a housing need, and then the institution, based on its policies, can see how they could mitigate that by paying the loan proceeds to the supplier as opposed to the client directly.
Yeah, just also to add on the loan diversion, there's always another option of loan disbursement in tranches, but you'll find most of the MFIs, their MIS cannot allow that. So they'll give the client all the money and you are left to that diversion to handle. But if the system is flexible for institutions that have flexible MIS, loan disbursement in tranches has always solved that problem.
That's an important issue, Stephen. Will you be getting to that level of detail in future sessions?
Yes, in the bolts and nuts. Yeah.
That's excellent, because I think that really is where things either work or break.
Yes.
Is how you manage and service that loan once it's extended. So I'm going to, thank you both, because this has been a really great session. You have had fabulous engagement from a very interested audience. We will go through all of the questions and see if we can answer them directly by email. And then also we'll ask for Stephen and Bezant to consider them in the context of the future lectures as well. I think that will be a good idea. David Temba, who wasn't able to express his question, it's been recorded now here, written down. And an important thing that he's talking about, which was the same as my question, which was, how do you link housing microfinance and the incremental housing process it supports to the larger housing delivery context in which that household is living? So there's a government policy, there's municipal bylaws and requirements. And so I hope we deal with that also in a future session, just to think about how housing microfinance fits within that wider context. We're going to let everybody go now because we've come to the end of our time. But this is great. I'd like to encourage all of the participants, if you have an idea, send it through. Send it by email. Nasipi's given you all the details of where to connect. So to Nasipi or Tandiwe or myself or indeed Stephen, send it through because we'd really like to look both in terms of what we address in this webinar series, but also if there's specific areas where we should be studying a little bit more carefully and documenting. Housing microfinance gets a very sorry level of or degree of attention given the amount of activity that's actually happening. And we want to shift that. So your ideas on how we broaden this, the awareness of this sector would be very helpful. Bezant, you want to comment on these on this slide here?
Just to show the roadmap of where we are going with webinar 2 and webinar 3, in terms of some of the questions that remain unanswered. We're hoping this would cover them, but we will definitely reflect on the questions that have been shared and to see what we can address in subsequent webinars or elsewhere, a depository on where we can address the questions.
Great. And if anyone has any case studies or literature that they want to share, please send it through to us and then we'll share it with the collective. That's really the point of the AUHF Academy, is that we want to create this peer learning space where we all learn from each other and get motivated by what each other is doing in the sector. Thank you very much, Bezant and Stephen. Excellent inputs. You've gotten lots of accolades in the comments. And we'll see you in a month's time.
Thank you, everyone. It's been a pleasure.
Thank you. Bye-bye.
Thanks so much, everyone. Bye-bye.
Bye-bye.